The next chapter is money market and capital market in India. Indian financial system is based on four pillars: financial institution, financial market, financial instruments and financial services. Now let's talk about the financial market. Financial market is split into two parts: money market and capital market. Money market is a market for lending and borrowing of short term funds. It is a market for near money. The structure of money market is basically split into two parts: the organized structure and unorganized structure, that you can see on the slide. Organized structure include Reserve Bank of India, commercial banks, cooperative banks, developmental financial institution, discount and finance house of India, while unorganized sector includes indigenous bankers, money lenders and unregulated non-banking financial intermediaries. The first and foremost institution in money market is Reserve Bank of India. It is under RBI Act 1934. Reserve Bank of India commenced its operation from 1st of April 1935 and get nationalized on 1st of January 1949. As per Professor W.A. Shaw, Reserve Bank is a bank which controls the credit. So, the function of Reserve Banks will be: first one, issue of currency notes; second, banker to the government. It means whenever a bank is in need of funds, it can approach Reserve Bank of India. Third one, bankers bank. Like we have our account with the banks, other banks like State Bank, ICICI, Saraswat Bank all have their account with Reserve Bank of India. The fourth one is custodian of foreign exchange reserve. It means the entire foreign exchange reserve of India is with Reserve Bank of India. Next one, controller of credit. Basically, through their qualitative and quantitative technique, they control the credit in an economy. Controlling of credit means inflow and outflow control. They can do this by using the methods like bank rate, open market operation, cash reserve ratio, statutory liquidity ratio and fixation of margin, credit rationing, moral suasion, etc. Reserve Bank of India also collect and publish the data. It promote and development function in the banks, and it is the clearing house or the settlement house for all the banks. The next point is commercial bank. Commercial bank is as per the Indian Banking Regulation Act 1949. It means the bank which accept for the purpose of lending or investment of deposit of money from the public, repayable on the demand or otherwise, and withdrawable by check, demand draft order or otherwise. So that is the definition of commercial bank. It can be further categorized into four sectors: public sector, private sector, regional rural and foreign bank. The functions of commercial bank is: the first and foremost function is accepting deposit. It accept deposit from people in the form of demand or time deposit. The second function is providing loan and advances. The deposit which is collected by the bank is given to the people who are in need of funds in the form of loan and advances. The third one is the ancillary function which bank do. Ancillary function includes your locker facility, transfer of funds, collection of money, making periodical payments on your behalf, etc. The next important function which bank do is credit creation. Credit creation is nothing but creation of credit, that is creation of money from one person to another. The money which bank takes from us in the form of deposit is given to the loan to the person who are in need of it. So in this way, bank creates credit. The next one, cooperative bank. Cooperative banks came into existence with the enactment of Cooperative Credit Society Act of 1904. Cooperative credit sector comprises of cooperative credit institutions such as primary cooperative credit society, district central cooperative bank and state cooperative banks. The next one is development financial institution, also called as DFIs. They help in the development of industry, agriculture and other key sector. Industrial Finance Corporation, that is IFCI, was the first developmental financial corporation to be established in the year 1948. The next one, DFHI, that is Discount and Finance House of India. It was set up in the year 1988 as a money market institution based on the recommendation of Wagul Committee. It is a jointly owned by Reserve Bank of India, public sector banks and financial institutions to impart liquidity to the money market instruments. Now let's have a look upon the unorganized sector. Unorganized sector includes indigenous bankers. They are the financial intermediaries that function similar to the banks. They mostly deal in indigenous short-term credit instrument such as hundi, but they do not have any legal authority. The second is money lenders. Money lenders are the people or the wealthy people in a rural area which provide money to the people who are in need. They are again not regularized or authorized by Reserve Bank of India. The third one is unregulated non-banking financial intermediaries like Nidhi companies. They are the chit fund companies which work in the financial market but do not have any recognition. Now let's have a look upon the role of money market in India. Money market help in short term requirement of the borrowers. It helps in liquidity management. It helps in portfolio management. It helps in equilibrating mechanism. It helps financial requirement of the government, implementation of monetary policy, economize the use of cash and growth of commerce industry and trade. The problems which money market face is dual structure of money market, that is organized and unorganized sector. Lack of uniformity in the rate of interest. Every bank, cooperative institution, DFHIs are following different rates. So there is no uniform rate in the entire market. The next point is shortage of fund. Money market faces shortage of fund due to inadequate savings. Then seasonal fluctuation. Like season affect the agriculture, so it does affect the money market as well. From October to June, finance is required on a large scale. So it has a seasonal demand. Then lack of financial inclusion. Banking facilities in the country are still inadequate and inaccessible to the valuable group. So it has a lack of financial inclusion. The last one, delays in technological upgradation. The use of advanced technology is a prerequisite for the development of banking sector. Here we lack. There is no technological upgradation. The capital market in India. Capital market is a market for a long-term fund, both equity and debt. Capital market is a very big market. You can see that on your slide that it is split into 4 parts: government securities, industrial securities, developmental financial institutions and financial intermediaries. Industrial security market is further split into 2 parts: new issue market and old issue market, while development financial institutions include IFCI, ICICI, SFCs, IDBI, IIBI and UTI, while financial intermediaries are merchant banks, mutual fund, leasing company, venture capital companies and others. The role of capital market in India. Capital market helps to mobilize long-term saving. It provides equity capital to the government and to the business. It provides operational efficiency. It is helpful in quick valuation of the asset and it is an integrated market. The problem which capital market face is financial scams. You must be knowing about the Harshad Mehta and Ketan Parikh scam. Then insider trading and price manipulation. Since it's a market based thing, it's a market linked thing, so price manipulation is quite possible. Then inadequate debt instruments, decline in the volume of trade. And the last one, lack of informational efficiency.